This is Robert Kraft, and I'm your host on SNN.Network YouTube channel, the Planet MicroCap podcast, and the reason why you're here right now, the Planet MicroCap Showcase Virtual Investor Conference. So thank you all for being here, and I'd love to introduce to you our very special guest, one of our virtual keynote speakers, a raconteur unto himself, Tobias Carlisle. He is the founder and managing director of Acquirers Funds, and he's the host of the Acquirers podcast. Toby, always great to see you, man. Thank you for doing this.
Hey, thanks for having me, Bobby. Love chatting.
Love chatting with you too, man. So, for this virtual keynote, we wanted to do it a little bit differently. We put out to our respective Twitterverses, our FinTwit community, to get some questions, and we got some good ones. And so we'll answer those in a second. But before we do, I figured let's start off with the Tobias Carlisle State of the Union. Since everything went down with the pandemic, officially now a pandemic, let's hear your thoughts. What are you doing? What are you seeing? Where are we at? The floor is yours.
Well, we came off an extremely expensive market and we've fallen as fast as we ever have before. I think it's faster than 29, faster than 87. And now we've had this monster bounce. And the question is, have we seen the bottom? Is this rally sustainable? Just a few comments that I would make. One is that I think that they're incredibly difficult to call. Bottoms in real time, virtually impossible. Nobody really knows until like a year or so after the fact. And then you look back and you say, I guess that really was the bottom. But I think they're really tough to call in real time. And the reason is you have times like 2000, 2002, 2007, 2009, which I think that I would call them mega bears rather than just like a technical bear like 2018 that just kisses 20% down and then rockets up. Also true of sort of 2016 and 2011, which were, I think they were technically bears because they were down 20%, but really they bounced like golf balls off a concrete path and just rocketed back to new all-time highs. The question is that going to happen this time or not? The answer is, I don't know, but these are the things that I'm looking at when I'm thinking about that. One of them is that CAPE, the cyclically adjusted PE, for as much as folks don't like that metric for various reasons, because it's, for a long time, it seemed to understate earnings because it included the 2008 bear market, which wiped out all of the earnings for 2008. So that seemed to understate. And then now folks say, well, it's got 10 years of kind of above average earnings, which suggests that CAPE might be even higher than it actually looks. But that's the function of CAPE, to make that cyclical adjustment. And you can look at other similar metrics like Tobin's Q, which looks at the replacement value of assets versus the market value of those assets. When the market value massively overstates the replacement value, then you have an overvaluation. And you could look at something like Buffett's metric, which is total market capitalization, gross national product. They all give you roughly the same answer. They say that we're still very overvalued. Markets never bottomed in this kind of range of overvaluation before. Possible, but it just hasn't happened before. The other thing to think about is Cam Harvey, who did his PhD dissertation in 1986 on the yield curve inversion. So he looked at, when he wrote the dissertation, he looked at 1960s, 1970s, and 1980s bear markets and recessions that sort of went along with those. In each instance, the yield curve inverted beforehand and there were no false positives. So there were no instances when the yield curve inverted and we didn't then go into a recession. And the reason that's important is because it probably tells us something about what's going on in the underlying economy, more than it just sort of being a technical indicator. Since he published his dissertation in 86, it's correctly called every bear market since and recession since, and it's had no false positives. Last year in about July, the yield curve inverted. Cam Harvey went and he talked on Meb Faber's podcast. He talked to Josh Brown. It was written up in Business Insider. It was everywhere as the yield curve is inverted, and that typically means that we then go into a recession and a stock market crash. And folks just seem to forget about it. And then coronavirus showed up in China, and we knew it was kind of rampaging across the world. For the first 3 weeks of that, I remember distinctly people saying, where's the volatility? There's no volatility. And then all of a sudden, we've had this very rapid crash. So I think that there's probably more going on than just the virus. It's not to downplay the seriousness of the virus. It's obviously extremely serious, and it's doing a lot of damage to the underlying economy, whether that's the shutdown or various other things as well. That's a debate you can have with someone else. But I think that whatever's happening, there's some very serious issues right now. So I think, given the backdrop and given what's happened, I think it's just very difficult to say that we have in fact bottomed when we haven't seen any of the filings, we haven't seen any of the data. Then again, if you're a value investor, any value investor will tell you that the DCF doesn't turn on, doesn't really make much difference what happens in the first year or so, because valuations are typically in the terminal value, and the terminal value shouldn't be too impacted. So what I think has happened is that we've had a very expensive market that's fallen very rapidly. We've bounced into another very expensive market, and we've seen no data on the underlying. So I think that we're probably more likely in a bear market bounce than a climb to new highs. What that means for investors, at a micro level, it probably doesn't mean much. And that I like to give the context of what's happening in the broader market, just because that sort of explains some of the movements in the portfolio. But for value investors, and particularly small and micro value investors, I think this is one of those, paradoxically, it's one of those generational opportunities. For value investors, it's fantastic. Value investors generally haven't seen values this cheap since sort of 2009 or 2000. So it's a really good opportunity to go around and pick up some undervalued stuff. For small and micro cap guys, this is a generational opportunity. Small and micro cap investors and small and micro cap value investors in particular, this is about as good as it gets. The indices for small and micro are all destroyed. Value investors particularly are destroyed. When you look at the bounce has been wholly concentrated in the bigger companies, and the smaller the companies, just as you go down the stack from sort of large cap, mid cap, small cap, micro cap, they've all bounced less and less. And so micro cap is small and micro really in a deathly bear after having a really rough decade, really rough last few months, terrible crash, now not bounced at all. I think this is about as good as it gets. And if you don't have a small and micro cap exposure, now is the time to go and get some, or to find your friendly small and micro cap fund manager and value guy particularly, and I would get in there. So that's the way I see it.
Well, one quick follow-up to that, because I think one of the arguments that has been made, and I'm sure we both have seen on various podcasts and articles, is how this pandemic has severely impacted small business. And when we're talking about small micros, we're really talking about some of these companies, because it's not just the privates, it's also some of these publics that are getting affected there. So, as you said, this can possibly be a generational opportunity. For you then, what should our investor audience then look for amongst this grouping of this asset class?
Yeah, I think small and micro is one of those places where you can really shine as a stock picker, because a lot of small and micro is just if you can avoid the very worst, you can improve your returns enormously. And if you can identify the very best, you can improve your returns again enormously. And we both know lots of Ian Cassell, lots of other really great investors in the space who almost doesn't matter what happens, Cassell's going to crush it. And I think the things that you would look for, first of all, they're just not going to be they don't have the financial resources as bigger companies, so they probably can't last as long with the total shutdown of the business. So balance sheet strength is incredibly important, but it's not enough for small and micro cap, because they're going to deplete their resources one way or the other. I think if something is highly levered, it's in a lot of trouble in this environment unless it can access a bailout. So cashy balance sheet is the first thing. Ideally, even through something as rough as this, it's still generating at least cash flow, so they're not insolvent. That's that's a question of looking at the balance sheet, looking at the cash flow statement, and then thinking about the business a little bit too. What kind of business is it? Is it a business that can survive through a period like this, or is it a business that's going to be up against the wall? It's one of those funny markets that it really presents incredible opportunities, but there are a lot of landmines out there. So that's the way I'm thinking about it. Good balance sheets, good cash flow statements, and then you have to kind of project that forward through this period where we don't yet have any data and figure out what's going on.
Well, one thing that we talked about actually I did our podcast panel recording yesterday, and the audience will hear the podcast panel a little bit later today, is especially talking about the small microcaps, is being able to separate between the COVID, and I say this with all due respect, but like the COVID plays versus the real, long-term compounders, real long-term, just companies that'll last a lot longer than, just providing potentially a COVID solution, in the near term. So how do you kind of separate the two, between some of these companies that might be more COVID based, you'll see the earnings in Q2, Q3 of like, oh my gosh, they're up over 120% in their revenues, versus the companies that maybe don't have as great of earnings, or they're down in some of their earnings coming up. How do you look at that?
Yeah, I'd be highly suspicious of anything that pivoted towards COVID when this came through. I mean, I'm Australian, so I've seen lots of mining companies become .coms, go back to being mining companies, turn into like blockchain type plays, and they're probably COVID type plays right now. So for one thing, you probably just put a line through those ones and not touch those ones. But that is a good question. There are going to be some companies that do benefit from this type of environment. The trick to investing, though, is to find a kind of differentiated view. You need to find a company where that's either not yet known to the general market, or the market hasn't become aware of the fact that this thing's going to benefit, and so it's not yet reflected in the price, or where it is, you've sort of got some view that it's going to be much better than the market is expecting. I think, because I'm a deep value guy, I always find it easier to go to the places where there's total devastation and they're probably going to do a little bit better than everybody thinks. So that's kind of the way I think about it. That's not to say that I think it's a lot harder to do, again, to raise Ian's name again, but I think what Ian does is quite difficult, because what Ian is doing is saying these things are a lot better than folks think. And he's got some very pronounced skill in that area. I think that's hard. I think for guys like me, you're better off just finding things that have been babies thrown out with the bathwater, And I know you're familiar with, you're getting a lot of work with babies right now.
Yeah, you definitely don't throw the baby out with the dishwater. You definitely don't. I've learned that firsthand. You don't do that. So let's get to our Q&A portion. These are some questions that were sent in through our Twitter, and thank you to everybody who did respond. So first up from at C MicroCaps, Coffee MicroCaps, Mark, shout out. Thank you very much for sending in this question. So his question was, given the speed of this crash, how do you find opportunities quickly, conduct due diligence quickly, and build your required position quickly?
Yeah, that's a really good question. It's something that I think about that a lot, and my business is set up to operate for exactly these types of environments. Like, big crashes are, for value guys, it's like the Super Bowl, except it doesn't come around once a year. It comes around like once every 10 years. So it's like an Olympics, or every second Olympics. So you got to be ready for these kind of things. So I always have my shopping list of companies that I want. I've got my screen running all the time. We're doing work on those beyond the screen to figure out what we want, where we want them. And so I have my ideal portfolio, which is distinct from the actual portfolio that we already hold. So the ideal portfolio, so I got an opportunity to do that. The fund that I'm currently running is a bigger, is a mid-cap and above fund. So for me, it was great. When those opportunities came through, I just went through and picked up Berkshire, I picked up Markel, I picked up Schwab. So it was an opportunity to kind of upgrade the quality of the portfolio at bargain basement prices, which, you don't get very many shots at Berkshire if you're a deep value guy. And so you got to pin the ears back and buy when you do get them. So that's how I do it. I am constantly running the ideal portfolio, and that's positions that I could, if we were rebalancing right now, I would go and buy them. So in that process, we've already done a lot of the work to identify them. We've done a lot of the work to make sure that we are comfortable with the balance sheet, with the business, with the cash flow, with management, that they're doing all the things that we like, buying back stock. And, because we're long short, we're looking on the short side as well. We're looking at, does it have a really junky balance sheet? Are they just spraying cash out the door? Are these businesses that really need to raise capital to make it over the next 12 to 24 months? And when they do, will that create a catalyst that'll tank the stock? So that's basically how we're doing it, running it all the time, updating it kind of daily or weekly. And when the opportunity arises, we jump on them.
So I guess your advice maybe to those who don't have access to your screen but have their own screens, that they should constantly be running them just to find any sort of opportunities that are out there, especially right now.
Well, you go through periods of time where you have nothing to do, right? There's periods of time where the market's really, really overvalued, and you're kind of scraping around for any kind of molecule of value, and it's hard to find anything. And then you have these times when it's just a flood, and when the flood comes, you got to be. Buffett says you got to run outside with a bucket, not a thimble, and so that's what we try to do.
That's great. That's great advice. I love that phrase. All right. So our next question from Twitter was from @econ_student, but the O was, looks like a 0. So and his name is Chris. So thank you for sending this in. He's interested to hear more detail on how Toby thinks about the rise of passive and how that impacts his strategy. I think he was directly referencing the interview that you just did. Forgetting who,
Michael Green, the Michael Green interview.
Right.
So Michael Green's thesis is that there's this passive drip into markets, and passive, definitionally doesn't look at the value of the thing. The market capitalization, weighted positions in most of these big ETFs, SPY, and most of the big indexes that are based on the S&P 500. What they do is, regardless of any consideration of the fundamental, they're always just buying the biggest market capitalization weighted float adjusted company. And that means that the investors who are more price sensitive are typically the ones who are selling to those guys. And you can get this scenario where there's so much passive in the market that there's no active anymore. So it's just passive competing with passive, and passive doesn't sell for price to fundamental reasons. Passive doesn't sell. Passive may sell eventually to meet redemptions and things like that. So what he says happens is the market goes into this exponential crack up boom, and at that, because the last marginal dollar can't go in because there's no marginal seller because it's all passive. So the marginal dollar of buying, there's no price at which that can be satisfied. So that means you get this vertical ramp. And then you have this crack up bust on the other side when they're selling for, boomers are leaving the work, retiring and pulling down on their assets. And there's a trigger soon where I think the median boomer becomes 72.5. They have to start drawing down. And he thought that was like the 2018 behavior was some of that. The 2018 crash might have been caused by some of that. My view is, the problem with that view is that it excludes any other possibility of any other cause of crash. And I think that what you see and this is the difficulty that I have with Michael's thesis, that any boom, any stock market ramp, any big bull market like we've gone through, or other ones in the past, they always have passive flows going to them. Folks just chase price appreciation. They chase price trajectories. That's always happened, and it always will happen. It's just that it varies from time to time where that money is directed. And so if there's any other event that comes along, and we might say like a yield curve inversion, we might say coronavirus, it could be a real estate crack up, .com crack up, anything else. I think that anything else could potentially pierce that thesis. And I think we've kind of seen a little bit of that. Michael has said that he still thinks that the reason for the crash was so severe is because there's still some problems with the structure of the market. And he thinks that we're going to see, I think reading between the lines, what he says is that we're going to now see passive still flowing into it. And it's going to create that we're going to go back to that same behavior as we saw before. My view is, the bigger the price distortions that there are in the market between price and fundamentals, the better it is for guys like me who are active. I think that I can go through there and identify the things that get left behind, because there will be things that get left behind. And I don't really care if the market doesn't recognize the quality of these companies, because there are folks who are outside the public market ecosystem who can force those prices to their fundamentals. And that's private equity guys and activists or other strategic acquirers. So I think that I don't see how Michael's thesis plays out without it benefiting fundamental value, private equity, activists, small and micro. That's the kind of market that I would actually, frankly, I'd love to be in it.
Got it. All right. So I would want to follow up, but we're on limited time. So I have two more questions. So, well, actually this next one's more of a statement and topic that I think you've kind of alluded to already, but we're going to go through it anyway, because I really enjoyed it. From Rodney Smith, at Rodney LK Smith, writes, here's a good topic. John Templeton says in his Maxim 14, and I quote, "Too many investors focus on outlook and trend. Therefore, more profit is made by focusing on value," end quote. Now, when are you going to get that tattooed?
I'm going to get I'm not going to get it. I'm not going to get any more tattoos, but I'm going to get. I'm going to get Ars Poetica before I get anything else. The quote at the beginning of I think that I'm going to tweet that Graham quote. Many will be restored that now have fallen, and the commensurate part of that, I think, on as close to the bottom as I possibly can. I'm going to quote that, and I'm going to tweet that out. I think that'll be as close as I get to getting anything tattooed on me. But it's a good line. I like that one.
Me too. And guess what? That'll be the signal right there to all the mark. When just look
That's
out for
my guess.
Yes,
that's my guess. And you should know that I have no special skill in picking bottoms. I'm as bad as everybody else.
All right. So our final question, and this one is the most serious one that we got in. And I think you will love to understand what Toby's answer is. And this is from the Senator Eloise Williams, CFA, MBA, PhD, doctor. She wrote in, if Jerome Powell announces he has a third nipple, how would you position your portfolio?
Yeah, I saw that question when it came through, and I think I said I already include the possibility of a nubbin in my back test, so I'm already ready to go. Yeah, it's funny. I think that we watch Jerome Powell so closely these days. It's a little bit sad, but then it's been going on for, I remember when I was a kid, guys who had the Greenspan Buddha doll, and they used to rub Greenspan's belly for luck. So I think that Fed watching is as old as time immemorial. I think it'd be healthier for the markets if there was a little bit less intervention, but I don't know how popular that sentiment is, so I'll probably try and keep that one to myself for the most part.
For sure. Well, Toby, with that, that's going through some of our questions. I mean, any parting takes before we let you go here?
Yeah, I would just say it's an incredibly exciting time to be a value guy. Value has performed really poorly for the last decade. It's been a growthier kind of market. I think that that's ahistorical. Value typically does quite well. We need regime change for value to really start working. Regime changes are typically characterized by enormous volatility. We've got that volatility now. So I think that the next decade is going to look like a very good one for value investors, particularly for small and micro cap value investors. And I think it's going to be a tougher market for the growthy guys who are going to see, even though those companies are very good, they'll still see very good growth, but they've got so far ahead of their fundamentals, they need to grow back into their fundamentals. So I think it'll look more like the first decade of this millennium rather than the second decade for the third decade.
Well, Toby, with that, thank you so much for joining me for our virtual investor conference, sharing your thoughts. Where can my audience and everybody listening in right now find all the information that they need on you, Acquirers Podcast, the Acquirers Multiple, the Acquirers Fund?
Yeah, thanks very much for having me, Bobby. I always love chatting to you. I've got a website, acquirersmultiple.com. It's got some screeners on it, and it talks about all of the stuff that we do. It's got links to the books that I've written. Acquirers Multiple is the most recent one. The Acquirers Fund, the ticker ZIG, it's listed on the NYSE, and the website is acquirersfund.com. I also have a firm, acquirersfunds.com, which is the plural, and that kind of describes the process that we go through. And I think we'll have some exciting news in the small and micro cap space over the next few weeks. So you have to stay tuned, and hopefully I can come back on and talk to you about it.
Oh, I cannot wait to hear that. That's going to be awesome. All right. Very cool. Well, Toby, thank you again, and stay safe, and I'll talk to you soon.
Thank you, sir.